Hello everyone, my name is Torin Dove and welcome to the Torin Dove Financial Channel. It's no surprise to any of you who have watched some of my videos that I'm a massive fan of passive investing. And so for the topic of today's video, I'm going to try and give you some tips and tricks on how you can really take advantage of passive investing and actually make it work for you. Of course, sometimes when we hear the terms passive investing, we seem to think of it as kind of a giving up investing, the alternative between active investing and passive investing. A lot of us, when we kind of think of the words active and passive, we tend to think that active is going to be the guaranteed what we should be taking advantage of, what we should be utilizing, and that, of course, sitting on your butt and doing nothing is not going to be the approach. But investing isn't like everything else. It's not like going to the gym and being passive versus active. No, active investing is more like being on hands-on approach on everything in a way. And passive investing is more making your investments properly the first time and doing minimal turnover. So first off, I want to attack the narrative that passive investing is only investing in ETFs, setting it, and forgetting it. It doesn't really look like this. In fact, in my personal portfolio, I use a little bit of a mix between passive and active investing. It's kind of weird that you can use one part of investing strategy in one portion of your portfolio and another in a completely different section, but I'll kind of try and explain a little bit what I mean by that. So for me personally, I utilize an approach called the core satellite portfolio. This is where I have the core, or what I would call the future nest egg of my portfolio, in an index fund. For me specifically, I do the S&P 500, and I use Vanguard's VOO S&P 500 ETF. And then, of course, we have each of our individual satellites. And for me, what I like to do with this is have it in single stock selection. However, this doesn't necessarily make me an active investor. Rather, I do a lot of my investment process before I actually implement anything into my portfolio. So another video topic that I actually covered quite recently is that a lot of people only spend 6 minutes on average before they actually add something to their portfolio. And again, I showed kind of why that's a bad thing in a previous video, and I'm not trying to go in on that tangent all over again, but a lot of the active portion of my investment management comes in the early stages of deciding what I'm actually going to make cornerstones of my portfolio. See, the good thing with the core satellite portfolio is, while I may kind of just be set back and laid back in terms of the S&P 500 and maybe some other ETFs that round out my core, I can afford to be more active with a concentrated portfolio of single stocks that round out my satellite portion. So I think the number one best approach you can early on take that'll help you actively be able to better passive invest is, of course, going to be finding a strategy you can stick to and something that works for you. For me, I've tried a multitude of strategies over time, and not all of them have really resonated with me. I've tried trading before. I found that to be a bit of a losing game. I tried a bit of swing trading here and there, and I didn't like the process, and it wasn't really something that I could stick to long term. For me, what really resonated with me was kind of not necessarily trying to take great value investing ideas, but as I learned more and more about great value investors, kind of use some of those principles and ideas and implement them into my own portfolio. And for me, this is where I really started to see significant success in my portfolio. I realized that when I wasn't trying to constantly find new things to invest in and trying to take minimal profits when I could instead hold them for long periods of time, my investment portfolio did better. I'd say the first moment where I really realized that this idea of more passive investing worked for me was when I actually went to study abroad. So at the time, I was doing frequent transactions. I was continually trying to make as much money in the short term as possible, doing a lot of trading, and it was a lot of work, and I didn't feel like I was necessarily receiving the gain that I should have been getting for how much work I was actually putting in. And so right before I did a semester abroad in Italy, I wanted to create my portfolio in a way that I could actually just kind of set it and leave it there and not really have to keep up with anything and not have to worry about anything. And this coincided right in this is the time I was in my investments class, and a lot of the things I was reading outside of class, like works by Benjamin Graham and Charlie Munger and books on Warren Buffett, it really just resonated with me. And so I front loaded pretty much all of the research process that I would be doing on each of these new opportunities and trying to figure out what's good now and what's hot in the market and what might potentially be hot in the market. And instead, I tried to front load all of that research into finding great quality businesses that I felt would be perfectly fine no matter what happened in the next 3 months as I went abroad. And this is actually where I saw significant returns in my portfolio. This was actually where I had my first double bagger, and where I found a lot of positions that went up 100, 200% because I was investing in the right things originally. I just wasn't waiting around long enough to see the success from it. So I invested in a lot of small caps, large caps, and mid caps that were all in business models that I fully understood and could explain even to children, which I think is an important thing, being able to explain that well and in depth something and even be able to kind of come up with how you would explain it to somebody who knows nothing about your positions whatsoever. And I was able to hold on to those through ups and downs, and I wasn't really concerned at all. And it worked out the best I've ever been in investing. And so it was really this where I kind of stumbled more into the idea of front loading all of your research process and then trying to have low turnover inside of your portfolio. Because I'm somebody who's identified multiple times great business models and invested in companies like Nvidia's, Apple's, Microsoft's, but it's something that at the time, I didn't necessarily get the full reward I could have by simply waiting there and letting the great business model and the shares appreciate with this great business model and revenue growth and all of those factors. It was just something I was trying to get as much money in the near term as possible. The next thing I would say that will really help with mastering this passive investing idea is having realistic expectations and time horizons. A lot of people, if you ask them what type of return they want to see on their investments, they just throw out crazy, wild numbers. The market has actually averaged about 10%, and if you look at the past 20 years, it's closer to 11% in the S&P 500. You can't just come out and say, oh, I want to have a 200% return in my portfolio next year. Because if you come out and say that, that can be a goal for you, but you have to understand that you have to take so much risk that you can also just have your portfolio be completely wiped out. And so I think setting these realistic expectations of, hey, I want to either match the market over the entire time that I'm investing, or I want to have my initial value in my portfolio 2x every 5 years or so, that's an acceptable goal. That's something that with 15% compound annual growth you can achieve. But again, a lot of people set these really unrealistic expectations, and that makes them want to get into the short term, you have to act now mindset, because you don't really necessarily have a way to guarantee that you can actually achieve these unrealistic expectations unless you are taking advantage of active investing, of which I have previous videos explaining that even the professionals can't do that as well. So again, something I've mentioned repeatedly in this video, front load the majority of your research prior to the actual selection and putting something into your portfolio. This not only is going to make everything in your portfolio significantly easier, it's going to help you sleep at night. You aren't going to be, oh my goodness, what happens if this, if this, if this? Because a lot of those questions in terms of what happens if it goes down 5%, those really originate from not really understanding what a stock is. It's not just some trading card. You own a business share of a company. And also not really understanding the business model, not caring about the fundamentals of the business, what direction it's going in. A lot of those questions really don't matter. I think one of the best things I've ever heard in terms of this topic that really a lot of investors should look into is, if you buy a house per se, if its value goes down 5%, you're not going to immediately panic and sell it. Or if you have a small business and suddenly what you could get if you tried to sell the entirety of the business went down by 5%, you wouldn't be rushing out the door trying to sell it to people. Instead, you might look more at the fundamentals and see, okay, does this reaction make sense? Or you might look at, say, if you had quarterly earnings, you might look at this and be like, is this a justified reaction? When you start finding yourself have those types of questions, I think you're definitely on the right path as opposed to only caring about the price. Because as you'll probably quickly learn in your investment journey, price and actual intrinsic value are two completely different things. Next, what I would advise all of you have, and this is something that has absolutely continued to be a great blessing in my portfolio, is having strict rules for selling. For me specifically, my selling rules boil down to two things. My investment thesis absolutely imploding itself. Let's say I have a company, and I'm not going to use a current example definitely if you've kept up with the microcap mania at all. Let's say I have a company, and I really like their products, and I think that they have something that's unique to the marketplace. And then they decide to switch the strategy entirely and come up with a really stupid product that nobody wants, and now they're going to focus solely on that and let their successful business die. That might be an implosion of my investment thesis right there. The management team is not aligned with reality, and I can kind of see that and say, okay, this is going to be a sinking ship. The captain is driving us into the iceberg, and I can either decide to go down with my investment or get off and save whatever money I still have in this position. So that's one thing that would cause me to sell a position. Another thing is the opportunity cost. Now, something I really like doing is as you become more thorough and more knowledgeable about each of your individual positions, I like to personally give my positions a numerical score out of 10. This just makes it really, really simple for me, 1 through 10. That way, when I'm looking at all of the available opportunities, because there are thousands of stocks and companies you can invest in, not all of them justify swapping out something that's a really, really good cornerstone of your portfolio. But at times, you will absolutely have companies that maybe you had really high expectations for and they haven't been able to perform that well, or maybe you just didn't see something that the market did, and you will find really, really good opportunities. So make sure that the opportunities you are finding are a numerical score on your own scorecard that would be significantly higher than your portfolio. And that's more where the active investing portion of my personal portfolio comes in. Now, I'd say a lot of the positions in my portfolio have been held for over a year, and that's something I really aspire to do. I think if you're consistently seeing positions only in your portfolio for a few months, a few weeks, short periods of times, quarters, whatever, then you're doing something wrong in your actual selection process of what makes it into your portfolio. Next, understand the power of compound interest. I advise everyone at the end of this video, or even now if you're kind of tuning out, that's okay, go to a compound interest calculator and look at, let's just say, $50,000 at a 10% compound annual growth rate for 30 years. I think this is the thing that in my very first investments class, everyone really peaked up. Because we hear these things like millionaires and we think they're so far away from what we could ever potentially get. But a lot of us, if we take advantage of compound interest, can actually become millionaires. It's not really that hard. Again, life has a lot of circumstances. There are going to be things that pop up, and some people are just flat out unlucky. And again, I empathize with those people. But being a millionaire is a lot more achievable than you think. And again, that's a laughable concept. I implore you, just go to a compound interest calculator, use the S&P 500's average annual return, and put in your time until retirement. Again, a lot of that does come down to you need a longer runway. Again, it's not the end of the world if you started investing late. It's better to invest than just not invest at all. And that can be a question for like comparing the CPI and inflation to like your savings account, for instance. You can do that. But again, if you have a longer runway, you need to be investing now, right now. Okay, next. Tune out the noise or conquer the impulses to trade on noise. This is something that I initially struggled with. I know a lot of people, when they go onto their YouTube channels, especially in this space, they like to pretend like they're just like the best thing ever. I am a human being. I have those impulses as well. It's something that I've had to conquer over time is, hey, just because I'm reading about this good investment opportunity in a publication I really like, such as the Wall Street Journal, doesn't mean I have to act on it. It may not be something that I feel confident in holding for the next 5, 10, 15 plus years. And so when you get to the point where you're able to read both positive things on your positions, negative things on your positions, and just not feel the influence to immediately act on it, I think you're going to be in a much better position. Something I necessarily don't really like, it would be kind of like the finance TV in a way. Now, there are sometimes specific interviews I want to see with people or CEOs of companies I'm following or things like that, and that's perfectly okay. But when you get all of the flashing tickers, it's like it's designed to get you hooked in this, oh, I have to act on this today. And a lot of people, that's the worst thing they can possibly do with their money is trying to act all the time. In a similar fashion to that, my next advice would be trying to look into platforms that really do incentivize long-term investments. A lot of the mobile platforms, like, again, they are good in terms of if you're not going to invest at all, I'd rather you be on Robinhood or Webull than just not invest at all. But me personally, I like platforms that kind of incentivize long-term holding and they don't really like gamify investing. And I think the two really like elite programs are going to be Charles Schwab and Fidelity. Fidelity being because that's where your 401k is, and Charles Schwab because they have the Thinkorswim platform and they have a bunch of resources. E-Trade's also good. I have a family who have E-Trade and they have some good resources too. But like any of the platforms that are full service that actually incentivize long investment horizons, that's going to be a sweet spot to live. Next, again, something I've touched on multiple times, but I actually have a really fun thing that I like to think of a lot. There's this quote from Warren Buffett. I'm not going to get word for word the entirety right, but basically he pitches investing like you only have 20 investment opportunities in your entire life. What are you actually willing to invest in? Because if you limit yourself to, and again, I'm not saying you have to actually limit yourself to 20 opportunities ever, but if you invest kind of like you're limited to 20 investment opportunities ever, when you do invest, it's going to be high conviction positions into actual companies that you can fully explain and you really understand on a deep, deep level. And these are going to be significantly more successful investments for you. They're going to be things you feel competent holding for really long times and taking advantage of compounding interest. It's going to be positions like that. And so that's something that I really like to think about. And my last and final thing, and this is more just a public service announcement reminder, stocks are not just trading cards. I know, especially for the majority of people on Earth who don't have significant net worths, they don't really see them as like ownership shares of a business. Because if somebody owns 5% of an entire company, then it feels like a real ownership share. But simply just viewing them as ownership shares and something I really like to do is when I invest in companies, I like to treat it as if I'm buying the entirety of a company, just as a mental model. And this helps me a lot with trying to understand, okay, is this simply a market reaction or is something going wrong with my company that I own? And this will really help you in terms of holding on to positions much longer. And again, holding on to good quality positions is the number way to build wealth when investing. So overall, those are my kind of tips and tricks of how you can harness passive investing and also trying to kind of settle some of the ideas you might have about passive investing and what it really means. It doesn't mean you have to just give up and invest in the S&P 500 ETF and never look at the stock market ever, or just do nothing with your investments. Even though arguably if you do just park it all in the S&P 500 forever and do nothing, you're going to be well off. That's just kind of a fact at this point. But Overall, passive investing is something we should all kind of aspire to do, especially when you start looking into the stats. And I already kind of covered those in a previous video, but just look at the success rates of day traders. Look at the success rates of even the professionals at active investment management, comparing that to the S&P 500. Play the game that you have an advantage in and that long term you can see success in. So thank you very much for checking out today's video. I hope you found it informative, or maybe it kind of like helped you with some of your ideas that you're having personally. And as always, I really appreciate your time. Thank you.